Three, two, one. What's up, man?
All right. Look like you're across the country, but we know that's not exactly true.
Yeah, I know. Jerry's looking mighty professional today with his lighting and everything. We are in the process of moving offices, and in the course of that, we are building out a new podcast studio because we have a whole room dedicated to that now. So hopefully it'll look better, but because of that, stuff is everywhere, and so
Yep.
probably for the next couple of weeks we won't be back in the studio till we get it all set up. But anyway, I'm in my dark office, and Jerry is in his nice studio in
Little condo.
somewhere in the Bahamas. I'm
Yeah,
just
I
kidding.
wish.
All right, man. What you got for this week? It's been a wild and crazy week.
It has been a crazy week. I just put out the market this week slide on Facebook and Instagram, and if you're following along in the market, it's been crazy. We had two really important inflation numbers this week, and they were both much higher than what was expected, and that caused kind of a lot of volatility this week. We're going to go through. Actually, that's what this weekend's post is going to podcast is going to be about, is the PPI and the PCI, and then a third one, the PCE, which is the Fed's favorite inflation gauge. So we can talk about. We're going to do obviously the charts at the end, and we'll take a kind of talk through what happened and how it affects us really on a weekly basis. So CPI numbers came out on Tuesday. CPI is the consumer price index. The rate of inflation it didn't go up a lot, but it didn't come down as much as the market had expected. And then on Thursday, we had the producer price index, which also didn't come down as much as the market expected. So what that's saying is inflation is being more what they call sticky than what they would like, and that gives the Fed kind of the green light to go ahead and keep raising rates, which that's the initial thought of the whole thing when those numbers come out and they're above expectations. The thought is that the market's going to tank, which it did, and then it recovered back up several times throughout the week. So it's a very, very tough market, and for TSP investors with only two moves a month, you cannot play the intra-week Fed speak, trying to game what the Fed is going to do, and make reallocation decisions based on that. It's not possible. So we're gonna look real quick at what the CPI is and why we need to really pay attention to it. Same thing with the PPI, and then the third thing is the personal consumption expenditures, which we'll take a look at. That's actually the Fed's favorite indication of inflation, and then the TSP fund charts. So, like we always do, we take these slides from Investopedia. For the most part, I like to use them. So CPI, what it is and how it's used. Consumer Price Index, okay, it measures monthly changes in prices paid by U.S. consumers. Okay, it's what we pay for a basket of different things. So the Bureau of Labor and Statistics calculates it. It's a weighted average of prices of a basket of goods and services that represent the aggregate U.S. consumer spending. So they're trying to get an idea of how much the consumer feels prices of a basket of goods and services going up. Okay, that's what the CPI number is trying to capture. It's one of the most popular measures of inflation and deflation. So if we were feeling a decrease in prices, it would be deflationary. CPI report uses a different survey methodology, price samples, index weights than the PPI, which we're going to talk about later. PPI measures changes in prices received by U.S. producers of goods and services. So it's like the input price change for the producers that make the goods and services, so that they're two sides of the same coin, basically. So the first side is CPI that we're going to look at. So Consumer Price Index measures the overall change in consumer prices based on this basket of goods. It's the most widely used measure of inflation. Okay, and it's closely followed by policymakers, financial markets, businesses, and consumers. This is really why we want to pay attention to it. It's the most widely used measure of inflation, and it's really closely followed by policymakers, the Fed, and the market. Okay. Widely quoted CPI based on an index covering 93% of the US population. So this is kind of interesting. While a related index covering wage earners and clerical workers is used for cost of living adjustments for federal benefits. So that is something we're not going to get into on this, but that is kind of interesting for federal employees because there's a related but not directly related index that is how we got that big jump in cost of living this year. CPI is based on about 94,000 price quotes collected monthly from 23,000 retail and service establishments, as well as rental housing units. Housing rents are used to estimate the change in shelter costs, including owner-occupied. This is kind of a very big deal for the Fed, is the change in shelter costs, rent, and mortgage payments. Okay, so this is pretty much up to date. CPI-U, which they usually don't distinguish between the U, but the U is urban consumers. Okay, and that's why it represents 93% of the population. So it doesn't take into account people living in rural areas. But CPI-U increased 6.4% over the 12-month period ending January 2023. So it increased a half of a percentage point in January compared to a tenth of a percent in December of 2022. So it increased by 0.4%. Okay, so inflation is still going up. It's not a lot, but it's still going up, and it's more than what the market expected. So these are the 8 major groups that make up the Consumer Price Index. Housing is a big one, and it's one of the ones that the Fed is focusing on now because housing is on the biggest delay of all these major groups. When airlines change prices, you see it immediately. When rents change or mortgage rates change and you have to pay more for housing, it doesn't take effect immediately. And it happens on the fringes because everybody isn't, if you're in your house, if you're renting your place and your lease is going to run up in 6 months, and the cost of that, if your rent is going to go up, it's not going to be reflected in the data for some time longer than 6 months. But like for airline tickets, for example, as soon as the price goes up, everybody knows it. So some of these lag, and some of them happen in real time. Okay, so these are the 8 major groups that make up the CPI that the Fed looks at. Okay, so how is it used? It's widely used by financial market participants to gauge inflation and by the Fed to calibrate its monetary policy, which is whether or not it's going to raise or lower interest rates. Businesses and consumers also use CPI to make economic decisions. It's a measure of the change in consumers' purchasing power, right? So for us as individuals, it's a measure of, if you could buy a dozen eggs last month for $3 and this month it's $4, it went up 25% or 33%. The Fed uses CPI to determine economic policy with a target inflation rate of 2%, right, which we've all have heard about by now. The Fed, this didn't used to be a thing, but now their stated inflation rate is an annual 2% inflation rate. So we are well above 2% right now. And even if we get down to 2%, what that means is every year, because it's an annual, year over year number, the goal for the Fed is that every year your purchasing power decreases by 2%. So if you extrapolate that out, it doesn't take very long to where a dollar is what you could buy for a dollar today is going to cost you $2 a couple years down the road. And that's the goal. Okay, I'm going to try not to rant too much about that. All right, so that's CPI. Okay, that's how we feel increases in inflation. The PPI is how producers feel inflation, right? So when costs of materials to make the things that we buy go up, when the cost of those materials go up, that's what's trying to be reflected in the PPI. So PPI measures an average change over time in the prices domestic producers receive for their output. It's a measure of inflation at the wholesale level that's compiled from thousands of indexes measuring producer prices by industry and product category. Again, Bureau of Labor and Statistics puts this together. PPI is different from CPI, which measures the changes in price of goods and services paid by the consumer. Okay. So PPI measures inflation, and usually it's inflation. It's not ordinarily deflationary, but it's from the perspective of the product manufacturer or the service supplier. So the price trends for producers and consumers are unlikely to diverge for long, since producers' prices heavily influence those charged to consumers and vice versa. So if what that's saying is, if the price of a product to build goes up, the builder is immediately going to push that price to the consumer. So there's not a very long divergence between the time that the producer pays a higher rate and the consumer ends up paying a higher rate for the end product. Okay. In the short term, inflation at the wholesale and retail levels may differ as a result of distribution costs, as well as government taxes and subsidies. BLS releases PPI along with its constituent industry and product indexes during the second week of the month following the reference date of the survey. And this is kind of an important one too. It's based on approximately 100,000 monthly price quotes reported voluntarily online by more than 25,000 systematically sampled producer establishments. So both the PPI and CPI, they're not actually data that is comes from what you actually pay or what the producer actually pays. They're surveys. So the participants in the survey are telling the government what they paid. It's not like the government can pull the data. It's a survey. PPI at 6.2% right now. That is actually ending in December. I didn't have the January numbers weren't updated. They were updated on CPI, but not PPI. Wholesale inflation showed less than economists expected in November. Prices for final demand goods were offset by a jump in prices for final demand services. Survey covers the entirety of the U.S. output of goods and about 71% by value of services. So it's pretty comprehensive. Its component product and services indexes are weighted based on the value of the category's output to calculate the overall change in producer prices. So PPI is used to forecast inflation and to calculate escalator clauses in private contracts based on prices of key inputs. It's also vital for tracking price changes by industry and comparing wholesale and retail price trends. All right. So those are the two distinctions, right? The consumer versus the producer. So both PPI and CPI are important economic measures because they point to monthly changes in prices, but they reflect prices from a different standpoint, right? Producer price index measures prices based on the first commercial transaction for a product and service. This is in contrast to the CPI, which measures price changes encountered by the consumer, which is the end user. Okay. So those are the two big ones. And CPI came out on Tuesday this week. PPI came out on Thursday this week. Both of them were more than what the market expected. So inflation continues to be a problem, and because of that, they expect the Fed to raise rates. Now they're talking about up to 6% at this point. PCE, it's the Fed's favorite measure, and it's sort of a compilation of CPI and PPI. So PCE, it's a measure of the spending on goods and services by people of the United States. According to the Bureau of Economic Analysis, a government agency, PCE accounts for about 2/3 of domestic spending and is a significant driver of GDP. Okay. It's a measure of consumer spending constructed and reported by Bureau of Economic Analysis, along with personal income and PCE price index, which is a little bit of a different thing. PCE includes how much is spent on goods, durable and non-durable. Right, so durable goods are like cars and refrigerators. Non-durable are services, basically. PCE figures can affect decisions about business offerings, hiring, and investments. Okay. This is the Fed's preferred index. So in 2012, the PCE price index became the primary inflation index used by the Federal Reserve when making monetary policy decisions. So this is the main thing, sort of by definition, that the Fed is looking at to make monetary policy decisions. PCE better reflects changes to consumer spending, such as selecting substitute goods due to price changes, covers a broader range of spending. Past information can be adjusted to support recent information. They can work with PCE to sort of massage policy as opposed to the PPI and CPI numbers. It's weighted by data acquired through business surveys, which tend to be more reliable than consumer surveys, also used by CPI. So all three of these are survey driven. They're not the actual data. These factors result in a more comprehensive measure of inflation. That's questionable, but they're saying that that's a fact. Fed depends on the nuances that the PCE reveals because even minimal inflation can be considered an indicator of a growing economy. Okay, so this one is from the BEA. This is the most updated one, and the reason I wanted to put up this slide was because, where is it? The next release is February 24th. So if you're looking to, CPI and PPI are two of the most reported in Bloomberg and CNBC. PCE doesn't tend to get as that much kind of news attention, but seen as how it's by definition the Fed's most important indicator of inflation, you might want to watch and see what happens on the 24th of February when the new PCE number comes out. Okay. All right. So hopefully that gives you guys a little bit of an idea of the value of looking at those numbers when they come out. You can just get on and Google when the next CPI and PPI numbers are going to come out. That's always a big week.
Yeah, I think a lot of
Bloomberg
people
and CNBC.
just kind of that stuff just goes right over top of their head.
Yeah.
Myself included sometimes because they just start kind of spitting out numbers and and I feel like they do it just to fill air, right?
They do.
They make such conviction. They make statements with such conviction, and as you get more educated, you kind of listen to it and you're like, well, that doesn't really mean anything, right? I mean, they're just kind of pontificating about half of these things, right?
Yeah, it's amazing. If you turn on Bloomberg at 7 a.m. on a day that CPI or PPI comes out, they talk about what the market expects, what they expect the Fed is going to do, and then at 8:30, because these numbers always come out at 8:30 in the morning, it's hysterical to watch them reshuffle the talking points real quick to fit what the number actually was. Because right. they have to be able to justify it no matter what happens.
So yeah.
But you have to pay attention enough. Again, it's like riding a bike. You have to pay attention enough until you can get a feel for what the reality is. Just like if you were riding a bike and you kind of feel like you're a little bit off balance and you gotta move. It's It's the same kind of idea. You start to get the feel of it by watching enough, um, and it doesn't take that long to watch it and get a sense of something's not quite right. So, and it always always ends up in the charts anyway. So, TSP fund charts for the week. Um, Again, we always go back. The bottom line is we want to be on the right side of the market, right? So there's a couple interesting things to point out this week. So we're looking at a 3-year weekly chart of the C fund. The 20-week moving average line is in blue. Ever since we got this is the low in COVID right here. Ever since we got back above that blue line in COVID, every time we came down to that moving average line, we got support, right? All the way along until January of 2022, had a big break through that line, and we've been in the bear market ever since, right? We got a low for right now. It's the low of the market in October. We've had a couple of decent rallies. Well, all these rallies until the most recent one put in a lower low. So this correction in December put in a higher low. And that was really our first indication that something might be changing in the trend. And so the takeaway for on a weekly basis is that when price is above the blue line, it tends to continue higher. When it's below the blue line, it tends to continue lower. So where are we right now, right? We've been above the blue line for several weeks, and the moving average line has turned up, which is probably the most important piece of this chart. We can correct, price can come down to that blue line, right? Moving average line continues. If price can come down, find support, keep moving higher. By finding support at the moving average line, it can keep moving higher. Okay, it can't move higher if it's below the blue line, right? So that's why it's important to watch those moving average lines. Just because it's up here does not mean it's going to stay above the line, right? That's not a foregone conclusion. And the tricky part for us is the distance between here and here is, on a percentage basis, quite a bit. So if you want to let price come down to see if it's going to test the moving average line, and if it fails and closes below it, then you get out. This is your loss, right? So these are the kind of decision processes you gotta do to figure out whether or not you want to stay in the stock funds or be out of the stock funds or whatever. And we got the technical indicators, relative strength indicator, and the MACD that kind of help us do that. It's pretty easy to see that when relative strength is above 50, okay, got support at 50. When it's above 50, the 50 line, price is moving higher. Once it breaks below that 50 line, price is moving lower, right? And so now we're above the 50 line and we're declining. You got MACD is looking pretty strong. So you have to let the market breathe a little bit, right? It doesn't go up in a straight line. It's not collapsing right now, right? We're not seeing big moves down like that one. We could next week, but for right now, we've had 2 weeks of pretty orderly decline. So on a weekly basis, things don't really look that bad from the technical analysis perspective. From the macroeconomic perspective, things are bad and getting worse. So with that in mind, if you choose to be in the stock funds and let price come down, if it does, to that moving average line, just be very cognizant that if it breaks through, hard on the downside, if we get a week like this, you probably don't want to be in the stock funds after that. Okay. S fund, similar. It's a pretty good consolidation there in the S fund. I mean, we have this triangle, and ordinarily out of a triangle, the The next move is the same as the prior move. So this one to that one is the idea. And we're still above 50 RSI, and MACD is still positive. So on a weekly basis, the S fund looks pretty good. I fund, same kind of thing. I mean, we had a giant move above that 20-week moving average line back here, little consolidation, another move higher, and we're in a consolidation right now. No major collapses, right? Nothing like this. No collapses. So for right now, as of the close on Friday, everything is looking pretty stable. Could change next week, but it's pretty stable right now. And we are well above 50, and MACD, histogram is starting to roll over a little bit. Is that blue? The blue behind the two lines there. So MACD is a pretty good indicator. It's starting to flatten out, but again, it's not rolling over. F fund is interesting because it has been leading the stock funds, and it's also interesting because it reversed. It didn't close at the low for the week. It came down to the bottom of the wick right there, almost hit the 20-week moving average line, but then reversed and closed about the midpoint of the range for the week. We're a little bit below that 50 RSI, and MACD is starting to roll over, but still positive. So it's entirely possible that we saw support this week on that reversal, and the F fund keeps moving higher. It's also possible that this support fails and the F fund closes down here, and then the next target for the F fund is down here at 92. And since the stock funds and the F fund have been moving in tandem ever since the beginning of 2022, the F fund has sold off more in the past few weeks than the stock funds, but it could be leading. So it could be that the stock funds catch up to the F fund next week and in the coming weeks. So things to keep in mind and look at to try to make reallocation decisions. Obviously, if you're a subscriber to the site, we do it on a daily basis. And for us here at Grow My TSP, this is going to be it's a 3-day weekend. The market's closed on Monday, and we're going to be making some decisions this weekend as to what allocations are going to be going forward. Hey, questions?
That's my favorite slide.
I was surprised you didn't say anything when I put it up there. There you go.
Yeah, I know. Hey guys, if you have any questions, make sure you reach out to us at, well, you can go in the comment section wherever you find this video on YouTube or Facebook or somewhere out there in the Twitter sphere. And if there's no comment section, you can always shoot us an email at support@growmytsp.com. This was a good one. I know that a lot of folks might kind of like, it's one of those kind of dry topics, but it is worth going back and kind of digging into it a little bit so that when the folks are talking about all this stuff, talking heads, you can kind of like weed through their way of explaining it, I guess,
Yeah. The interesting thing right now is that if you follow, I mean, there's tons of rabbit holes you can go down on YouTube, but if you follow Bloomberg, is an easy one. They will they'll do interviews of people that are there are probably 5 different sides right now. There's a big camp that thinks the Fed is going to keep raising rates until inflation comes down to 2%. There's a group of people that think that the Fed is not going to be able to raise rates because it causes all kinds of other problems. And somewhere in there, the group that thinks that, the Fed's going to keep raising rates until something breaks in the economy, and then they're forced to pivot and reduce rates. And it'll be some kind of combination of that. Trying to manage TSP in the midst of all that is extremely difficult, right? We are definitely not in a place where you can set it and forget it. I mean, you can set it and forget it and you'll get the results that you get. But it's definitely a time where paying attention to the market is going to make a big difference in the bottom line of your account value.
Let's get an amen on that. All right, guys. If you have any questions, make sure you shoot them our way. Hope you guys are having a great week, and we will be back in our new podcast studio hopefully in a week or two. And until then,
Here we go.
We will see you guys.